Welcome to another episode of the Wealth Building Podcast. I'm your host, Jeremy Constantino, and with me today is my special guest, Sandhya Seshadri, who's going to unpack for us today one of the most critical aspects of investing, and that is determining the characteristics of a good deal through underwriting and value add. So, if you're new to real estate investing, or you're going to want to take notes, because what Sandhya is about to explain is could change your whole real estate investing experience. And give you profits. So, about Sandhya, she is an experienced general partner in all aspects of multifamily, from broker relationships, underwriting, analysis, and raising capital to closing syndication deals without delays. She is a general partner in over $110 million of volume and over 1,200 units, where she manages all in Dallas area. She's also a limited partner in over $200 million of assets throughout Texas, Florida, and Arizona. So, welcome to the show.
Thank you so much for having me, Jeremy. I'm excited to be here.
All right, let's just jump right in. So, tell the listeners a little bit about your background and how you got into real estate and where you're at now.
So, like most Asian geeks, I had a good math background and I got an engineering degree and worked corporate America because that's what we're taught to do is, make good grades, get a job, keep working that same job for 3 to 4 decades, and then, retire and die, and you'll have enough money to support your retirement with that. So that's exactly what I did. I also got an MBA in the process because I realized very soon into my engineering career that the sales, marketing, business types are making all the decisions. And I wanted to understand how they make their decisions. And that's where I got all my business knowledge to go into the stock market, as well as part of my MBA joined investor clubs. And then when I had children, I went full time into the stock market. But I came into real estate because I was looking for tax advantages. And every time I analyzed a single family kind of rental, I realized very quickly that one, I have to sign a loan, mortgaging everything that I own as a recourse loan. It limits my borrowing ability on future projects. I'm responsible in single family, at least, for most of the lovely 4Ts, as I call them, the tenants, toilets, trash, and termites, being a landlord, because the margins to pay a property management company just weren't there. And if everything goes well, I might make $200 to $300 a month on that single family rental. And that just didn't appeal to me. The amount of work I had to put in to make that kind of money wasn't worth it. So when I heard from a friend about multifamily, how you could buy large apartments, even ordinary people like me who don't have millions sitting in the bank can go out and buy large apartments by the syndication method, I was fascinated. So I joined a mentoring program where I learned everything that I know now. And that's what helped me get into my first deal from the active side as a general partner, teaming up with people with experience, because multifamily is a team sport. Learned everything I needed to know, picked the market, Dallas, which I'm most familiar with, where I've lived for over 32 years. And the rest was history, as we call it, meaning I've still stuck with it. It's been almost 4 years and I've thoroughly enjoyed my journey.
So, where did you go to school at for education?
I'm here locally in the Dallas area. I went to Southern Methodist University because I got a scholarship. It's a private college, but with a full tuition waiver, I was able to do that. And I also got a stipend.
So, how many years were you in corporate America?
I was in corporate America for over 12 years, starting on the technical side, doing test engineering, failure analysis, product engineering, and moving into marketing, and then running a large program like to the tune of $80 million
So,
for a Fortune 500 company.
so what was the spark that got you thinking about real estate investing while you're with a corporate 9 to 5 job?
I think my first transition was from corporate America into the stock market itself. And then I wanted to diversify from the stock market into real estate because I feel like most millionaires do so through real estate in some way, either just from appreciation of the value of your real estate over the decades. But again, I didn't want to be a landlord. So that's why multifamily appealed to me, because you employ a full-time property management company that takes care of the day-to-day aspects. We have employees at our property, like property manager, maintenance staff, etc., who do the day-to-day work. And as an asset manager, I get to supervise that.
So, did you ever buy any single family rental properties?
Nope.
You just
I
skipped
went
that.
from 0 to 86 doors as a general partner in
Wow.
my first syndication.
Wow. So yeah, my background is I did the opposite. I started investing in just small single families. And so I did what is typical the stereotype of a real estate investor. You start out small and you kind of work your way up through a
Mhm.
larger single family, and then you maybe like a fourplex or eightplex, and then maybe 20, but not
Mhm.
straight from 0 to 86 like you did.
Yeah, for me, it was intimidating actually to do what you did because I don't have a handy person's background to go fix something. So if somebody called me with a leaky toilet on Thanksgiving Day, first, I didn't want to be bothered. And second, I would never know how much it actually costs to fix it. It might be a $2 part and, maybe 30 minutes of somebody's time, but I could get ripped off and have to pay $600 for it. And there goes my margin. And then the other piece was, between tenants, you're not making money. So your income goes from 100% to 0, and you still have to pay your mortgage, utility bills, etc. So when I analyzed it, I just didn't feel like the effort I was going to take, putting a down payment of 20%, taking a loan for the rest of it, just didn't make sense to me. So that's why I skipped anything that was smaller than even 50 doors. It didn't seem like I could make ends meet to afford full-time staff on property. And 86 was my first, door count. And even that was right on the borderline. Right now, I only do anything 100 doors plus, 150 doors plus, ideally. But I'm not talking about 1,000 doors in one deal, which, might happen in the future. But right now, 100, 150 doors is like a nice sweet spot to where I can hire full-time staff, have property management run it, and I'm not involved in the operations at all.
Yeah, there's so much to unpack in going from 0 to 86 doors on your first deal. Like we could probably do a whole podcast show just on that topic alone. So I guess what we wanted to focus on today was underwriting and value add. Um,
Mm-hmm.
so I saw one of your presentations on your that 86 deal that you had. So thank you for sharing that with me. And what I was most impressed with you was how thoroughly you analyze uh, a commercial, a multifamily deal before you pull the trigger. So I guess let's start from the beginning. How do you find your deals? And let's just start with the process of finding multifamily deals.
So initially, it was mainly through all the major listing brokers in my market. So you've got to get to know them. That's the first step. The second one is, I invested passively in many deals too. So I knew a lot of the operators. And so I also knew a lot of the property management companies. So those are all sources. Certainly your lender is another source for you to find a deal. But once you get to know brokers and you've closed one or two deals, they bring you deals even sort of half off market, as I would say, where they send it to a smaller list of, syndicators whose criteria fits that deal, and they bring it to you. So my most recent deals have been sort of off market in the sense I hear about it first, I get first dibs on it, and then they might still take it to market a month later, but I get an early access look. And so if I want it, I know what price I have to get to and get it awarded. But yeah, major brokers, and because this is a major metro, all my deals are in the Dallas Fort Worth area.
That's interesting. So you have multiple agents, um, all sending you deals.
Yeah, there are many major brokers, listing brokers. From Marcus and Millichap has two major shops. There's Northmark, there's Greya, which used to be Greystone. There's so many different stores. There's Gray Steel, there's the multifamily group. There are a lot of large brokerages. So you want to get to know CBRE is another one. So you want to get to know every one of the major brokers in your market
Right.
to find deals, and you want to go have lunch with them, go tour properties with them, and be really smart when you tour those properties with them, meaning you want to have already read that memo, offering memorandum inside out. You want to know your rents. You want to have called and shopped around the comp properties nearby so that you have a pretty good idea what's the value add proposition here. And if the broker has an underwriting and they're offering memorandum that gives you certain numbers and you don't quite get to those numbers, right? They have what's called a whisper price. If you're not able to get to that whisper price and your gap is like $1 million, you have that conversation with them about how do you justify this in rep? How is your insurance cost so low? What is that assumption from? It's like, oh, well, I assume this large group, you have, the benefits of, volume, and therefore you can get a much better rate. Whatever explanation they give you, it helps you learn and get better at that underwriting.
Okay, so how about now moving into you see multiple multiple different deals coming your way. Do you have a set criteria that you say,
Mhm.
I want a property to give a return of X or percentage
Yes.
X?
Yes, for me now that I've done several deals, I'm on my, eighth or ninth deal now. I know what exactly to look for. I already have a pretty good idea based on the vintage of the property and the location, what's a price per door I should be paying for it, and what's going to get me the margins and what value add is still left in it. So I can't just do what's called a yield play where we just take over a property and we just, slightly raise the rents every year and keep going on. That's not going to be enough of a return to my investors. There's got to be a significant value add component to it. So the first thing we look for is deals where the rents are far below market. So as soon as I get a broker's listing and they give me this OM, T12, and rent roll. So OM is the offering memorandum. T12 is the trailing 12 months of financials, and RR the rent roll. You look at those three things and you can get a very good financial snapshot of the deal within that. So the most important thing to look for are the rents far below market and why. Do they need to be upgraded interiors? Or it's been a landlord who's owned the property for so long. Like the last deal I bought in March was owned by the original builder's son. So there's never been another owner of that property all this time. So there was a tremendous upside just from raising rents to market, even $100 across the board. These rents were like $200 to $300 below a comparative property of the same vintage, similar square footage unit, similar amenities, right? That's what's a fair comparison. So that's the first thing I look for is the rent itself, and then sources of other income that have not been explored. And then is there a way you can add more units to that property? Or maybe you could add more storage units, example, to get additional revenue. Do they lease to pets? I mean, we took over a property which had never allowed pets. So right there is we welcome pets, and here's a source of other income. Reserved parking, covered parking. Where else can you add value in ways that tenants want to pay for, right? Not everybody cares to pay you for reserved parking, but laundry, if you could add washers and dryers inside the units, anyone, even somebody who can't really afford it, would want to pay an extra $50 so that they don't have to take their laundry somewhere else because it's going to cost them just as much. And now the hassles of carrying it in the rain, in the summer, in the winter, especially if it's a single mom with 2 kids, and we target a lot of family demographics in our properties. So we look for the ones which have more 2-bedroom units, 3 bedrooms, etc.
So for the investors that are new, the real estate investors that are they're starting to learn, they may, can you explain the difference between the different real estate strategies? So we're talking about value add, but there's also the core plus that that the units are fully renovated already. They may have a little bit higher returns on an annual basis, but you like to focus on value add strategies. So there's 2 different strategies, and the investors are trying to, it's on the risk scale. They think that, oh, if the property is fully rented out, the rental rates are already up to market value. They think that by investing there, they may suit an investor to get that instead of going after the value add, where they may have to spend some renovation costs, or maybe some uncertainty of raising the rents, maybe some uncertainty of filling the units.
You definitely want to go with proven strategies, even when it's a value add deal. So in a value add deal, for example, the example that you had watched, Jeremy, we had the leasing office located in one of the largest units in there. It was a 2-story, 2-bedroom, 1.5-bath condo where the leasing office was located. So we could easily relocate that to half of the laundry room. And we knew we'd get the rent because, hey, a similar unit was getting, the 1,200 plus rent for that property. So that was a value add where I knew it was a sure thing. So 1,200 a month times 12, you're at 14,000 plus in, additional impact to your net operating income, right? That was an easy one, right? Versus
Right, so
if I say I'm going to do reserved parking, that's speculative because you don't know if the resident is going to pay $25 extra just to park 3 spaces closer, as an example. So that would be something you'd want to do a survey and check. So every value add strategy that you propose you need to see how much of a risk it is and what are the odds that it's going to happen, right? So I don't include reserved and covered parking right away in my underwriting. I keep it like as a bonus that I'm going to survey and figure out and see if it makes sense. Because even if you want to do covered parking, there might be rules that the city might have for you to build it, etc. Right? So that's not a sure thing. But an additional unit in that case was a sure thing. Washers and dryers, right? If the connections already exist and it's something you can check when you do due diligence, because one of the things we do is a physical due diligence. So if you check that those connections work, adding a washer and dryer is a no-brainer. You know, it's going to cost you maybe $1,300-$1,400 for a washer dryer unit. And residents would be happy to pay $50 because, you know, one load of laundry is going to cost them $4 to $5. And, you know, having that convenience is most people would pay for it. So, you know, I would look at it in that sense. So I don't buy what's called distressed properties where, you know, half the units are down, where it's only 50% occupancy. I still buy stabilized properties, meaning that they would qualify for agency loan based on a 90% type of occupancy. So I still look for stabilized deals in excellent locations. I like for the neighborhood to be fancier than the property itself. So a C-class property, but in a more B neighborhood where the median household income is high enough to support my rent bumps. So if my maximum rent is going to be $1,500 per door times 12, you know, you're already at how much? 18K, somewhere there. So you want to make sure the median household income is times 3, so closer to 54K plus. So I look for high median household income that's going to be at 3x of my annual highest rent in the property, because then I have a higher probability that the tenants are going to be able to pay it, and I won't have a huge delinquency problem. So again, one of the properties we acquired in Garland back in March, today is, we're in August, the end of August, my delinquency is not even $1,000. And so I want to operate like that. I want to buy properties where my delinquency is going to stay low so that my collections match, you know, my expected pro forma numbers, and I can get to that faster. So I can be in year 2 pro forma numbers, even by, you know, 6 months into year 1.
That's fantastic. Eliminating the risk by looking at the proven proven aspects. So
yeah, not speculative aspects. So you should have thoroughly studied the properties nearby to see if that's reasonable for you to charge X dollars. Okay, trash, pest control, I'm going to add $5 to the nearby properties, charge that, right? Or do you want to just bundle it as part of your rent itself instead of nickel and diming your residents? So what's the expectations for people shopping around? So put yourself in the shoes of your customer, who is your tenant, who is your resident, who without whom you would not be in business, and shop like them, right? If I look at 5 properties around you, why would I pick yours over the others? And how do the other ones differentiate? What are they doing better that I can copy and do in my own property to attract the right residents to come and stay, and focus more on retention, good customer service, like processing their work orders quickly, because retention is your best bet, right? If you don't have to turn your units and you can keep retaining the same tenants, your renewal rate is high. That's excellent for your property because you don't waste time turning units. See, those 10 days that you have to turn a unit and get another new tenant, clean out, and all of that costs you money. And that's 10 days you're not getting rent. And 10 days is typical. It's usually even longer than that, depending on the level of renovations you have to do.
Okay, so for some of the newer investors out there, they're still trying to understand how the net operating income affects the property value when you sell. Can you explain, I guess, give an example like the Cleburne 86 unit, that how can you give some of the different examples of what you did that increased the value, but at the end of the day, how much it correlated to the sale price?
So net operating income is basically your revenue or your collections minus your operating expenses. So what does it take for you to operate the property? And you know, you take the difference, that's your net operating income. Net operating income divided by the cap rate is going to be the value or purchase of a property. So as an example, one of the things we did was we were able to add an additional unit by moving the leasing office out of the existing unit. So let's say that was $1,200 a month in rent. That's $14,400 a year in additional direct impact to the net operating income, right? So depending on what cap rate you use, right? And that's, you know, subjective, but a 5 cap is pretty reasonable in the Dallas area. So $14,000 on a 5 cap is like $280,000 direct impact to the value of the property based on one one improvement that you did, right? One improvement.
That blows my mind away from going from single family residence up to multifamily, because on a single family property, okay, what kind of value add can you do? You can maybe add additional square footage, but are you really going to add, if you add a new bathroom to the behind a single family home, are you really going to increase that property value by
Right.
280,000, or what your example, over
Yeah,
$200,000?
280K, right? So
And
the
this
biggest
this
thing
is
I
just
would
one unit
say,
that you're talking about.
yeah, exactly. And so you want to focus on what is the highest return or value I'm getting for a lowest impact, money I have to spend when you initially take over a property till you stabilize the property. You want to be doing all the low hanging fruits first. So as an example, in that Cleveland property, it was an all bills paid property. So we wanted to do everything we could to save money on utilities. So water conservation, going down from, 3 and 4 gallon large toilets to 0.8 gallon efficient toilets is going to reduce your water bill significantly. And along the same lines, we went into LED upgrades for the entire lighting throughout the property. One, it made it look much nicer, and two, it reduced our utility bills. So even if the impact, let's say, was to the tune of, $50,000 a year, let's say, right? $4,000 in savings average per month across all of those units. At 50K savings on a 5 cap, right? That amounts to $1 million.
Wow.
Right?
Wow.
So I'm just saying, if you added up 3 or 4 things together, like say water conservation, electric upgrade, and then let's say you did minor upgrades and you did $50 to $100 in rent bumps with basic upgrades, right? Not super fancy upgrades, not stainless steel all the way, but just replace an appliance if it's in bad shape. Let's paint the units. Let's just make sure all the knobs and stuff are all a uniform brush nickel kind of finish, as an example. And you don't even have to replace the flooring if it's in good condition. Why repair carpet and stuff? If they leave carpet in the bedrooms and just have nice wood vinyl plank in the main living areas and leave it at that. And if you could add up all of that and you could save 50K a year, which is only 4,000 a month across 86 stores, that amounts to $1 million in value of your property.
Wow.
So there's a lot of ways by which you can increase the value of a property, because you have the economies of scale when it comes to multifamily that you don't have in single family.
That's fantastic. Okay, so let's go back to the process of underwriting now. So we talked about having all the different brokers sending you deals. You start looking at analyzing the deals, making sure that there is opportunity for value add is what you're looking for. Does it meet your numbers? So after those meet your specifications, what next?
Once I find a deal that actually meets my specifications with a quick underwriting, like a quick and dirty back of the napkin kind of analysis, and it's like, oh, that price per door in that location, oh, I'm going after that. So for example, this year I've got 2 deals in Irving, because Irving as a location in Dallas is fantastic. So I already know my favorite pockets of Dallas that I like. So when I find something in a suburb that I like, that is, a reasonable drive for me, where I already know the location, and then I crunch the numbers quickly, like I don't list every expense out in detail. I just write, okay, total expense. This is what my insurance is going to be because I already manage properties there, etc. I have a pretty good idea of expenses already just from running a property there, right? So once I get those numbers together and they actually make sense, then the next step is to actually schedule a tour with the broker. And that's where I make my checklist of, okay, I need to go dig into these 4 things to see if there's an opportunity there. And same thing I do with my partners. Then I drive by during the day and I drive by at night. I park there at night, I get down, I walk around, I say, do I feel safe here? Because I want to welcome that single mom with 2 kids there. So that's another thing I do. And so while I'm already driving there, I try to shop at least 2 other properties. And I try to see if the leasing manager would let me actually look at an interior. And I tell them honestly, the competitive properties nearby, I say, I'm looking to buy properties here in this area. Who's your management company? I do a lot of my homework online. And so I plan half a day when I'm serious about looking at a deal with a broker, because I really want to be having that conversation. When you get those 20 minutes with a broker, that is the most valuable thing you can get. In markets like Dallas, your broker is everything for you to get deals. So I make sure I do all my homework ahead of time, and I ask all the right questions about the properties nearby to see what would work. And I make sure I ask the property manager who's doing this tour with me of my subject property, right? The one that I want to potentially buy. I want to ask them all of those questions because they love to brag. They love to talk about what's so great about their property, but they also tell you about what's wrong with the property, what you could improve. So I'd say, if I could give you $50,000, what's the first thing you would want to fix here? When it rains a lot, like it did today in a storm in Dallas, you have drainage problems. I love to visit properties right after the rain or even in the middle of a rain because it again gives you clues. So you do a dig further, right? When you do your property visit, you dig another level deeper into your underwriting, right? Into your due diligence. You come back and you fine tune your numbers, you get all your estimates, and then you make offers. And that's when you make the offer.
So how many
Mhm.
units do you like to see in person, the interior, before making an offer?
Oh, we usually only get to see one unit. At the time that you tour a subject property, they'll always show you just the one unit, and it's usually a very nice unit, occupied by a very nice tenant or a vacant unit that they've remodeled. Okay. You never get to see the full truth. So that's where you have to do your own digging and budget a little extra for those things. Like if I'm buying an old 60s property, I plan 10,000 a door overall for renovations, right? Versus if it's an 80s property, I might say 7 or 8K per door. But again, I would want to know who's the management company who's been running it, what's their reputation. I try to dig deeper even into the seller if I can to see how well it's been maintained and have all those conversations. But when we do the physical due diligence, which is after we're under contract, we've paid the hard money down. Now it's like, okay, I'm going to lose a lot of money if I don't close this deal. At that time, we take all the trades with us. We actually hire a professional due diligence company to come walk every unit with us. So even if it's 200 units, it doesn't matter. We're going to walk every unit. We're going to inspect every system. I'm going to know about the ACs or the chillers or the boilers, whatever it might be. I'm going to know about the foundation. I'm going to scope the plumbing lines. I'm going to look at every interior and know, oh, these units, this guy's a hoarder, and this one's a very well-maintained unit. Oh, I'm going to have to do a lot of repairs to this unit versus this one. Oh, most of these units are already nicely upgraded, so I don't have to spend too much on the interiors here. Let me go see what I can do with the exteriors or add value with, washer dryer connections as an example, or Wi-Fi or something else in ways that the tenants actually want to pay for. Not trying to make a 60s property look like a palace interior, for a, $2,500 rent kind of place, right? So, you're only going to get 1,200, 1,300, 1,500 in rent. You only want to do this much in upgrades. And so that's the kind of homework you do when you actually have access to the property, which is after you're under contract.
So let's go back to writing the offer. In your experience, how many offers do you write for how many offers are accepted? Are you one that likes to offer low and have some rejected, or you like to just go ahead and put an offer in and get those accepted? I guess what's your
I
percentage?
don't offer low. I don't want to earn a reputation with brokers that I'm offering low and just fishing for opportunities. I want them to know that I'm not wasting their time. So I actually ask them for a whisper price before I even tour a property. I don't want to waste their time, or I tell them ahead of time, if you want a free tour, if it helps you with your numbers, I'll come and tour the property, but I don't think I can get to your whisper price. And I tell them that up front. And sometimes they like it. They still want to say that they toured so many people. And some others are like, okay, I don't need to do that. Like, you're the only person I'm going to have to come out there to tour. So if you're not going to seriously make an offer, then, I don't want to tour it. Let's just have coffee kind of thing. So I don't make a lot of offers. And in fact, I think this year I've actually been awarded every deal I've been offered, which is 3 deals. So I don't go about offering on 20 different deals. I also like to do one deal at a time, because I do so many aspects of it. I do my underwriting, I do my comp analysis, I also raise capital. I'm going to be the asset manager. I like to talk to the property management company. So I'm not one who likes to have 2 or 3 deals happening at once. So I do one, I close it, then I go to the next one.
So to clarify again, you don't have an agent working for you, and you don't have a buyer's agent with a listing agreement for you, or a buyer's agreement for you working. Every time you offer a property, it's with a different broker on the listing agent, correct?
Yes, it depends on who has that listing. Is it Northmark? Is it Marcus and Millichap? Is it, CBRE? Is it Greya? It's whichever broker has that listing. They are the ones to whom you have to tour and discuss and make an offer. They're the ones you want to build a relationship with so that you get the deal awarded that you really want.
Okay, so let's go to the due diligence period again. So in the due diligence period, now you can go back and do some renegotiations maybe. Is that part of your plan or not really?
No, in Dallas, in hot markets like Dallas, which I'm sure it is very similar in Phoenix, Atlanta, Tennessee, places like that, um, it is still predominantly a seller's market. You don't get to go renegotiate unless it's something hugely major. I hear that this year people have retraded because the interest rate went up, but I have never done that. I have not planned for it. I go in fully with the expectation that I'm going to pay whatever price we agreed upon, and I'm going to take the property as is. And there's no warranties, and I just take it. And I take it with all the skeletons and deep buried in there, whether it's bad tenants and delinquency issues or units in very bad condition that I've got to go fix up, right? Or I've inherited really bad reviews and I've got to make it better, whatever the case might be.
So you're really doing what I'm hearing you say is you're really doing two things during due diligence. One is you're getting your business plan together. You're starting, time's ticking. I need to have a specific game plan for how I'm going to add value with all these different things. That's one. Then I'm also hearing possibly you're doing enough due diligence to give you, it's just a red light or green light, and there may
Yep.
be something that just pops up that says,
Yep.
okay, I got to back out. I spent some money on due diligence, but the risk is too high, so I need to back out. So have you backed out of a deal yet?
So I'm blessed to say that I've not had to back out of a deal. That, the surprises are usually surprises we've already budgeted for. So as I drive around a property, I know what my parking lot repairs are going to be. I have a pretty good feel for what the foundation repairs might be. I pretty much know that, depending on who I'm buying it from and who the management company has been, I know the state of neglect, shall we say, of the property, or the state of good care of the property. The broker usually lets me in on that too. And same with, when you drive around, probably at least 10% of the ACs have to be replaced. So you kind of know all of your major CapEx items that's going to be involved, except for the interiors. That's the one thing you still don't have a clue about. But the fact that it's been rented and you look closely at the rent roll gives you a feel for how long the tenants have been there, how bad the units might be, and what rents they're getting for it. And that's a good feel again for, okay, somebody's living in it. How horrible can it be? And sometimes you're surprised and it's pretty horrible, but you want to make sure when you do those unit walks, I make small notes for myself. Okay, unit C106 is in really bad shape. I don't know how the tenants have been living there for that long, but that's got to be fixed. We got to move them to another unit so we can go and fix this unit. So I make those kind of notes. So I usually do a lot of the interiors. I have a couple of partners who love discussing, chillers and boilers and electrical systems and foundation and all that. So they go out with the exterior guys. So we split up our duties because we get 2 full days usually for our physical due diligence, and we have our roles and we know what to look for.
Wow. So what I'm hearing also is that your decision-making time, whether or not to go for a property, is that time that you tour the property for the very first time. You're there, you're meeting with the property managers, and you're spending spending a couple hours at night, seeing what the property is like. So those first couple 24, 48 hours, or about how much time do you devote to spending to analyzing the property before you send in the offer?
Typically half a day.
Wow.
I like if the deal is so good, like I have certain pockets of suburbia of Dallas that I love. So if, like, say, Irving, I'm going to immediately go look at it, right? And I probably already know about a lot of the properties there. So I'm going to look at the price per door. I'm going to look at the vintage of the property. I'm going to do a quick drive-by. I'm going to do all my analysis. On the computer within an hour, I can do a lot of that. Yep. And then I'm on my car because it's a 30-minute drive. I might as well drive by. And the time that I spend thinking about it, I could just be driving, taking videos, pictures, etc. Because I have a couple of partners who are out of state as well. And so it's easy for me to share that data with them, maybe FaceTime them, and then they'll tell me, go look for this, go look for this. And so if a deal is that good, I'm going to drop everything and go do it, right? So, and I only do that, this year, I've only got 3 deals. Last year was 2 deals. So it's not like it's 2 deals a day that I'm analyzing, it's okay, pass. What is the address? No, pass. Thank you. I don't need that. Right. So I already know my locations that I want and the locations that I don't want. So it's also based on the county. It's based on the street map. It's based on what's near it, etc.
So as a former engineer, yourself and me, I'm a chemical engineer background. We love our spreadsheets, and I'm sure you probably have
Yeah.
made your own.
Mhm.
Is that the case? Did you make your own spreadsheet to analyze, or did you borrow from somebody else and tweak it yourself? Or I guess.
I tweaked an existing one. So I'm part of a mentoring program. So we get that analyzer sheet. I've looked at a couple of others that are, available in the market for a couple $100. Then I take them and do my own tweaks to them. So I add an additional layer of, pref equity, whatever else, right? You need to do to modify your spreadsheet to make the numbers, give you the answers you want. But it's not a matter of, is it a $10 million deal, $20 million deal, or $30 million deal? It's at the end of the day, how much of my time is going to be taken up working on that deal for the next 3 to 5 years versus how much of a return is it, right? And so I look at the headache factor also when I choose deals. So if it's too much of a headache, then I don't bother because it's not worth my time. Even if the profits are equally the same between two deals, I'll go for the deal that's a little bit easier than the deal that's going to be a big headache and stress me out. And whether the value add is a sure thing or it's more speculative, right? The less speculation there is and the more certainty there is. I look at the risk adjusted returns, just like, say Sharpe ratio in stocks. So which gives me the most value for the risk adjusted return. And that's how I pick my deal.
Right. So anything else you want to share with, I guess, either new investors into the market, or even
Yeah.
experience? What else do you want to share?
So if
Already
you
done your homework.
are trying to get your first deal, definitely partner with somebody who's already done it in that market. Even if your returns are a little bit less, you'll get there faster with fewer mistakes. And when you raise money from other people, you want to make sure that first deal is a home run, not just average, because that's how you build your raving fans. If you're a passive investor, you definitely want to find operators who've already operated properties in that local area and have some experience, because the price of experience actually is priceless. You don't know what you don't know. So make sure the first time you do a deal, passive or active, go with a team that's experienced in that local market. They have a property management company who's experienced in that local market. And a property management company might have done a fantastic job in a different city. But if you're going to be their first deal in that new city, you don't have the economies of scale, so to speak, right? If I have a property management company that's managing 1,000 properties in Dallas, then I can borrow and I can learn from them. They have a vendor list. I can borrow a maintenance guy if mine's out for a week, etc. So go with experience in your first deal and learn everything you can. Don't worry so much about the margins, because then it'll be a cascade snowball effect. Your second, third deal, everything else will come. And the knowledge you got from that first deal is priceless.
It's fantastic advice. Usually entrepreneurs, we want to go do things ourselves and just not share. We want all the profits. But what I've been seeing is the most successful investors out there, they'll jump right on in and only take 20-15% of the first deal. They'll do all the work, but they just want the knowledge, and it's priceless.
That mentor, it's who you know, that mentor, the connections. Yep. You like, even in passive investing, right? I'm passive in 23 deals. That's 23 different operators I know that I can just pick up the phone and call if I run into a problem. I have a fire in my property today, as an example, right? I know at least 5 people who have dealt with it. They'll immediately tell me the shortcuts. So I'm not waiting maybe 7.5 months. Maybe I'm only waiting 5.5 months, right? And right there, I saved myself 2 months of hassles, and they'll give me a checklist, right? So it's who you know in the business is so crucial. And you build relationships either by investing passively with them or by working for them, doing more of the work. Like in my first deal, I did more of the work, but I didn't get much of the profits. And that's a fact, because I would give anything to do it all over again, the same thing. I would not change a thing, because what I learned from those 2 experienced operators and that home run first deal is priceless for the launch of my business. So
it's fantastic.
Think long-term. It's a marathon. It's not a sprint.
That's right. Well, I think we're running out of time. So where can the listeners learn more and find you online?
LinkedIn is a great place where I post frequently. It's the best place to connect with me. My website is Multifamily for You, where it's multifamily spelled out, number 4, and then YOU.com. They can put their name and email address and send me a short message, and I can connect with them that way too. I'm also active on Facebook.
Excellent. Well, thank you so much for being on our show.
It's been wonderful. Thank you so much for the honor of being a guest on your podcast.
Excellent. All right. Well, that's a wrap for this latest episode of Wealth Building Strategies Podcast. Thank you.